Assalamualaikum class. In this lecture, we will be covering bonds payable, including the issuance of bonds at a premium or discount, calculating the interest thereon, and dealing with the amortization of the premium or discount as the case may be. So first of all, we should know some basic definitions or some basic concepts. What is a bond payable? So bonds payable are a type of long-term debt that a company issues to investors in the form of bonds. When a company needs to raise capital, it can do so by issuing bonds, which are essentially loans from the investors. The company promises to pay back the bondholders the value of the bond at the specific future date, which is also known as maturity date. Moreover, the company also agrees to pay a periodic interest payment. So, what is periodic interest payment? Periodic means it may be yearly payment, it may be quarterly payment, it may be semi-annually or monthly payment. These interest payments are also known as coupon payments. And the company promised to pay bondholders until the bonds mature. The next is bond premium or the bond discount. When the bonds are issued at a price higher than their face value, the difference between the issue price and the face value is called bond premium. For example, bonds are issued at a price of, say, $12, whereas their face value is $10. So the bonds are issued higher than their face value. So the difference, which is $2, is the bond premium, and this happens when the bonds rate is higher than the market interest rate. Then bond discount, when the bonds are issued at a price lower than the face value. The difference between the issue price and the face value is called bond discount. For example, bonds are issued at $8, whereas their face value is $10. So the difference between these two is $2, which is called bond discount because bonds are issued lower than their face value. This occurs when the bond coupon rate or interest rate is lower than the market interest rate. Next is amortization of premium or discount. We have just discussed bond premium and bond discount. So the amortization of that premium or that discount, it refers to the process of gradually writing off the premium or the discount on bonds payable over the life of the bonds. Writing off means to reduce or to eliminate. For example, for a premium, the premium is gradually reduced the bonds. The premium is gradually reduced over the bond's life, which decreases the interest expense on the income statement. Basically, if the bonds are issued on premium, then that premium will be adjusted in the interest expense on the income statement. Basically, the premium decreases the interest expense on the income statement. So do remember while we will do this on exercises that premium will reduce the interest expense. And the vice versa in the case of a discount, that is, the discount is gradually added back over the bond's life, which increases the interest expense on the income statement. So, discount will increase the interest expense on the income statement when interest expense is recognized in the income statement. Premium will be decreased. Premium will be, you can say, interest will be decreased when the bonds are issued at premium, and interest will be increased if the bonds were issued at discount. So for practicing these concepts, we are using Financial and Managerial Accounting books by William Zaka Bettner, which is also known as Meigs Accounting. We are covering chapter 10, Liabilities, and we will do exercise 10 point, brief exercise 10.3, 10.4, 10.5, and 10.6 in this chapter. So let's get started, and I'm sharing with you the Excel sheet here, this one. So this is brief exercise 10.3. In 10.3, the company sells $1 million to general obligation bonds for 98. This 98 means you can say at $98 means $100 bonds is issued at $98, mean this is at discount, on discount, or you can say at 98%, um, because the face value is 100%, which is $100. So this is the bonds are issued in discount. The interest rate on bonds paid quarterly at is 6%. The interest rate on bonds is 6%. The company is paying 6% interest rate. What is required? Number one, calculate that the amount that company will actually receive from the sale of bonds, and the amount of both the quarterly and the annual cash interest that the company will be required to pay. So, two things are required. First of all, we are going to calculate a requirement, um, the amount the company will actually receive. Uh, so, cash received by the company after the issuance of bonds. So the basically you can say the bonds are issued at 98. 98 means you can say 90 on 98%, or $100 bonds issued at $98. So company is getting 0.98. So the total amount of the bond is 1 million multiplied by 0.98. So this is what the company is getting after issuing the bond. This is actual cash. So how much the amount is, okay. So this is in dollars. So $980,000 is the cash received by the company as required in requirement number A. So in requirement number two, interest is required, or and total annual cash interest. Cash interest means the interest which the company is going to pay to the bondholders. The quarterly interest required and the total annual interest is required. So first we are going to calculate annual interest, and in annual interest total amount of the bonds is 1 million. Now the interest rate is 6%, so we multiply this amount by 6%. The total interest or total annual interest would be $60,000. So this 60,000 represent total annual interest, and quarterly interest payment, and this would be $60,000, which is annual interest. How many quarters are in a year? Four. So we are going to divide it by four. So 15,000 per quarter. So this is the interest payment per quarter. So in this problem, we have calculated total cash received by the company and then annual interest and quarterly interest payment. The next brief exercise is 10.4. So in 10.4, now $1 million are issued. The bonds for $1 million are issued for 101. 101 means for $100 per bond, the company is receiving 101, or you can say at 101%, which is at premium. The interest on bonds paid quarterly, payments are quarterly at 5% interest rate. So first of all, what is required? Actually cash received from the sale of bond. So the requirement A is cash received from the sale of bonds, and $1,000 or $1 million multiply by 0.101. So the actual cash that the company received is this one. Mm, So this one and dollars. So 101 means when we divide it by 100, converting it into percent, this is 1.01. So 1.01. Here it is 1.01. So the company is getting 10,000 more. Means for a bond payable of 1 million, the company is getting 1,010,000 dollars. The next is annual interest. The amount of both quarterly and total annual cash interest that the company will pay to be the company will require to be paid. Okay, so annual interest, and annual interest will be calculated on the total amount is $1 million multiplied by interest rate is 5%. So annual interest would be 50,000 per year. It's 50,000 per year. This is the annual interest, and the quarterly interest. So quarterly interest would be the annual interest is 50,000. So we start from this 50,000, multiply, divide by how many quarters are in a year? 4. So we divide it by 4, and the quarterly interest payment would be $12,500. So this was brief exercise 10.4. The next exercise is 10.5. The company sold bonds at 97. 97 means on discount. $100 bonds was sold at 97 on an interest payment date for $500,000. $500,000. Assume the bonds will be retired in 10 years, means this is the maturity time, 10 years, and interest are paid annually. The interest payment are annual interest payment. calculate the amount of cash that will be received and paid by the company in the first year as an interest expense that will be recognized in that year. The bonds carry a stated interest rate of 5%. The interest rate is given, which is 5%. So, in the previous exercise, what is the difference between this exercise and the previous exercise? In the previous exercise, you can see total annual cash interest was required. Total annual cash interest was required. Whereas in this case, the interest expense that will be recognized by the company is required. So, in this case, these are adjustments of you can say the bonds premium or the bond discount is also required because here in the start of the slides we have already discussed that the bonds will decrease the interest payment or decrease the interest expense for the income statement, or similarly if the bonds discount, then the bond discount will increase the interest expense recognized. So here that adjustment is also required. So first, the requirement is calculate the amount of cash that will be received and paid by the company. So first of all, we calculate the cash received or paid, and then interest that is recognized. It is not just the cash payment, but this interest, the interest which is required, the interest that is required will be presented in the income statement as well. So first, we are going to calculate cash received from the sale of bonds or issuance of bonds. How much cash is received? Uh, $500,000 multiplied by 0.97 because it is issued at 97. So we multiply it by 0.97 to calculate the net amount received by the company. So $485,000 is the total amount that the company received after the issuance of bonds payable. Then the cash paid by the company, cash paid by the company for interest expense year one. So total interest is paid at the rate of 5% and the interest is paid annually. So we do not need to adjust it further. So $500,000 multiplied by interest rate, which is 5%. So annual interest would be this one, $25,000. So this is the cash payment to the bondsholder, cash payment of interest to the bondholder. The next is the interest that will be recognized. So interest expense, we are going to calculate interest expense that will be recognized. Recognize year one. And first, we take cash paid. Actually, the cash which is paid is $25,000. So $25,000. Then we plus, because we have just discussed that the bonds issued at discount, if the bonds are issued at discount, then that discount will be added in the interest expense, or that discount will increase the interest expense. So we are going to amortize that discount plus amortization of discount. So how we are going to calculate amortization of discount? We have bonds are issued at 5 lakh. Then total amount of cash received is 4,85,000. So we deduct 4,85,000. So the difference between these two amounts, the face value and the bonds issued value, is by deducting each other. It is, and then um, this would be 15,000. I think let's 5 lakh minus 4,85,000. It is 15,000. So 15,000 is the total amount of discount, and the bond will be retired in 10 years. So life of the bond is 10 years. So we are going to divide this amount, or we are going to amortize the total amount of discount in the total life of the bond, which is 10 years. So by dividing 15,000 by dividing 10, we get 1,500. And so we add these two. So 26,500. What do you mean by this 26,500? While preparing income statement, the interest expense that will be recognized in year one would be 26,500, whereas the actual payment of interest is 25,000. This 25,000 will be paid to the bondholders. Whereas when the company is going to prepare income statement, the company will adjust or amortize the discount of the bond, and then that discount will be added in the interest expense to get the amount that will be recognized in the income statement. So this 26,500 will be presented or will be adjusted in the income statement. Whereas this is the actual cash payment, 25,000 to the bondholder. So this was 10.5. Now we are going to do a similar question with the bond premium. So the company Purple and Orange Corporation sold this $700,000 bonds on an interest payment date at 102. Now, previous bonds was issued at 97. So this was discount. Now 102 means at premium. Uh, the in same retirement period is 10 years. So and the interest is paid annually. Calculate the amount of cash received and paid in the first full year, as well as the amount of interest expense that will be recognized in that year. And the interest rate is 6.5. So first requirement is we are going to calculate cash received by the company after the issuance of bond. The total face value of the bond is $700,000, and the company is getting 102%, or you can say 1.02 times. So the calculation is in this way. So how much cash is received by the company? $714,000. So this is the cash received by the company. Then The next requirement is cash paid for interest. Cash paid for interest and year one. And this is the company of annual interest payment. So the calculation is simple. The bond's face value is 700,000 and we multiply it by annual interest, which is 6.5. 6.5 percentage is given. So 0 6.5%. Interest or annual interest would be 45,500. So this is your annual interest payment. This payment is to the bondholders. This is the cash payment made by the company to the bondholders. Now, the next thing is again we are going to calculate cash expense, but this cash expense is for the company. This is not for the bondholders. So cash or you can say interest expense recognized. Which year? Year one. We are calculating it for year one. How much cash we have paid? Cash paid is this one, $45,000, 45,500. And then we, because the bonds are issued at mm, premium. So this premium is going to be adjusted in the cash paid by the company, and this premium will decrease the total interest expense amount. So we are going to deduct it less amortization of amortization of bonds, amortization of premium on bonds or premium. So how we are going to calculate total amount is we have issued total issued amount. Um, Here you can say that we take the difference between this amount and this amount. Okay, so the difference between these two is 7,014,714,000 minus $700,000. The difference is actually 14,000 and the total life of the bond is 10 years. So we are going to divide it by 10. So amount is 1400. 1400. 1400. So the total interest expense that is recognized in the income statement is 44,100. Here we can compare it with the amortization of discount. We add the amortization of discount in the interest expense recognized, whereas in the case of premium, we deduct premium because the premium actually decreases the total amount of interest recognized, whereas this discount increases the amount of interest expense which is recognized in the income statement. And this concept we have discussed in the very start of this lecture. So that's it from this lecture. In the upcoming lecture, we are going to discuss how to record these concepts. How to record means we will discuss the journal entries related to the bonds. So that's it. Take care, class.